Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Well, the Fed has spoken again, and seems like everyone's trying to figure out, what Powell's saying these days. Yesterday's FOMC meeting and a press conference after. Definitely left us with a lot to talk about. We got another rate cut, the third in a row, but we also got some mixed signals on inflation, and you know what's going on with the economy. Maybe you can help unpack this. You got a quarter-point rate cut, bringing the target range for the federal funds rate to 4.14 to 4.12%. But at the same time, the Fed's saying inflation is going to stay kind of high in 2025. So are they hitting the brakes, or are they stepping on the gas?
Yeah, it's a balancing act for sure. I think you hit on a key point, though. The Fed is really, walking a tightrope here, trying to support the economy, but also not let inflation run wild. What's interesting to me is that a full percentage point drop from the peak rate in just a few months. That's a pretty aggressive move. That signals to me that they're really prioritizing economic growth and making sure the labor market is healthy, even if it means we're going to have to deal with a little more inflation for a bit.
But are they being too optimistic? Weren't there hints in the FOMC statement that they might be ready to pause these rate cuts? They use that phrase, extent and timing, which has a lot of people thinking, something's up.
Yeah, extent and timing. It almost sounds like a secret message. Historically, when the Fed uses language like that, it often means they're trying to get the market ready for a shift in policy. You can almost think of it like tapping the brakes a little bit before you come to a full stop. They're signaling that if everything keeps going as they expect, further rate cuts might not be needed.
So it's kind of like a warning, but not like, a full-on alarm. But here's what I don't get. Even with these rate cuts, we haven't seen things like mortgage rates and auto loans move much at all. Shouldn't those be coming down if the Fed's lowering the benchmark rate?
That's a great question, and it highlights how complicated the relationship is between what the Fed does and how the market reacts. It's almost like a tug of war.
Yeah.
You got the Fed trying to, push borrowing costs a certain way by adjusting the federal funds rate. But then on the other side, you got all these other things going on in the market, like what people think about inflation, what's happening in the global economy, and even investor psychology. And sometimes those forces pull in the opposite direction. That's why we don't always see a direct connection between the Fed's rate cuts and what happens to long-term interest rates.
So maybe the market isn't totally convinced the Fed can, handle inflation. Is that what you're saying? I mean, they did raise their inflation forecast for next year.
Yeah, they did. But if we kind of look past the headlines a little bit and dig into what they're actually saying, it seems like they're still pretty confident about the direction of inflation. They've said there might be a few bumps in the road, but they're pointing to a few key factors that give them reason to be optimistic.
Oh, lay it on me. What are those factors?
Well, first of all, they've pointed to the cooling of the labor market, which should help reduce some of those wage pressures that contribute to inflation.
Right. We did see the unemployment rate go up a little bit recently.
Exactly. And they've also said that housing services inflation, which has been a big driver of inflation overall, is starting to ease up. Plus, they still expect supply chains to slowly get back to normal, which should help bring down some of the pressure on prices for goods. They're basically saying, hey, don't overreact to a few months of data, but look at the overall trend, which seems to be heading in the right direction.
Okay, so it's a trust us, we got this kind of message. But even if we buy that, what about the labor market? Is the Fed being overly optimistic about that too? Unemployment is still low? But we have seen some signs that things are slowing down in recent months. How are they putting those two things together?
It's fascinating because it seems like the Fed is recognizing the nuances of the labor market. They're not just focused on the headline unemployment rate. They're looking at a whole range of things like wage growth, job openings, and labor force participation. And what they're seeing is a gradual and orderly cooling. It seems like they think this cooling is needed to bring inflation back down to their target, but they're also confident it's not going to lead to a huge spike in unemployment.
But wouldn't that mean it's going to take even longer for wages to catch up to the cost of living? If inflation is stickier than we thought and the labor market is cooling off, isn't that just going to make it even harder for people to make ends meet?
It's a valid concern, and it shows how tough the choices are that the Fed has to make. They're trying to balance their two goals, maximum employment and stable prices. And sometimes it feels like those goals are pulling in opposite directions.
It almost feels like they're saying, hey, we're okay with a little bit of a slowdown in wage growth in the short term if it means getting inflation under control for the long term.
That might be a little blunt, but yeah, there's some truth to that. It seems like the Fed's thinking is that if they can get inflation under control now, they can create a more stable economy that will ultimately be good for everyone, including workers.
So they're playing the long game. But what about how the public sees this? If people are still feeling the pinch of high prices, are they going to buy into this whole wait-and-see approach?
That's a really important question. It comes down to communication. The Fed needs to do a better job of explaining why they're making the decisions they're making and how they're going to get there. They have to be clear about the trade-offs involved and the possible risks and rewards. If they don't, they risk losing the public's trust. And ultimately, that could make it harder to achieve their goals.
And we all know how important confidence is, both from the public and the markets, to keep things stable.
Absolutely, it's all connected.
We'll be back in a moment to keep talking about Chair Powell's latest pronouncements. Stay with us. Welcome back to the Quarterly Call. Let's go back to this idea of public perception for a sec. You said the Fed needs to do a better job of communicating. But is that even possible with how complicated everything is? How do you explain like a 2027 target for 2% inflation to people who are struggling to buy groceries today?
It's a tough one for sure. The Fed can't just use all this technical language and expect everyone to understand what they're talking about. They need to figure out ways to connect with people on a more personal level, to explain how their decisions actually affect people's everyday lives.
Right, to get it real for people.
Exactly. One way to do that is to focus on real-world examples and tell stories people can relate to, like talking about how lower inflation means families can buy more stuff, or how a stable economy helps create more jobs.
Makes sense. But they've also pushed back that target date for 2% inflation a few times already. What would you say to people who don't believe they're going to hit it this time?
I get why people are skeptical. I mean, they've heard it all before. But we got to remember that predicting what's going to happen with the economy isn't an exact science. There are always things that pop up and mess things up that nobody saw coming. The Fed's got to be flexible and change with the times. I think it was important for them to really emphasize, both in their statement and during the press conference, that this target isn't just some random number they pulled out of a hat. It shows they're committed to keeping prices stable, which is super important for a healthy economy.
Like trying to steer a ship through a storm. You have a destination, but got to keep adjusting course because of the wind and waves.
Exactly. And that's what the Fed is doing, constantly looking at the economic data and tweaking things as they go.
Speaking of data, let's talk about the elephant in the room. The potential for things to change with the new administration coming in. I know the Fed tries to stay out of politics, but you can't ignore how fiscal policy might affect their decisions.
Definitely not. And Powell addressed that head-on during the press conference. He admitted that fiscal policy can have a big impact on the economy, and that the Fed is keeping a close eye on what's happening there. What's interesting is he kind of hinted that some folks on the FOMC have already started factoring potential policy changes into their economic forecasts. It's like they're playing chess, trying to guess what the other side's going to do.
So they're not just reacting to what's happening now, but trying to guess what might happen down the road. But how can they make good decisions when there's so much uncertainty about those potential policy changes?
That's the million-dollar question. It all comes down to assessing risk and planning for different scenarios. The Fed has a bunch of economists who are constantly running these simulations and analyzing different possibilities, trying to figure out what impact various policy changes could have, and come up with backup plans just in case, like prepping for a hurricane. You don't know when or where it's going to hit or how strong it'll be, but you do what you can to be ready for the worst.
Okay, but how do they account for those, totally random events that throw everything off? You know, like that butterfly flapping its wings in one place causes a hurricane somewhere else. Look what happened with the war in Ukraine. Nobody saw that coming. And it had a huge impact on the global economy.
You got a point there. Geopolitical risks are like wild cards. They can really mess things up, even if you planned everything out perfectly. And that's why the Fed needs to be able to move quickly and adapt. They got to have systems in place so they can assess those unexpected events and react fast.
Almost like being a firefighter. You train for all kinds of situations, but you never know what you're going to face until you get there.
That's a great analogy. And just like a firefighter, the Fed needs to be ready to jump into action when there's a crisis.
Let's switch gears for a minute and talk about something that kept coming up during the press conference. The disconnect between what the Fed is doing and how the market is reacting. Like, some important interest rates haven't really moved much despite the rate cuts. I'm talking about things like mortgages and auto loans.
Right. It's got a lot of economists puzzled, but I think it shows the limitations of monetary policy in a world where everything is so interconnected. The Fed can't control every single thing, and sometimes the forces at play in the market are just too strong to fight against.
Do you think it's possible the market just doesn't believe the Fed can bring inflation down to 2%?
It could be. Remember, the market is always looking ahead, trying to predict what's going to happen before it does. If investors think inflation is going to stay high for longer than the Fed is saying, they're going to want higher interest rates to make up for that risk.
So maybe the market is sending the Fed a message, like, we're not buying it. Show us the numbers, the lower inflation numbers.
That's one way to look at it, and it's something the Fed will definitely be keeping an eye on in the coming months.
Let's take a quick break. When we come back, we'll wrap up our analysis of Chair Powell's press conference.
Ah.
Okay, we're back. And there are a couple more things from Powell's press conference that I wanted to get your take on. First, someone asked if the Fed is worried about how the stock market's doing. It's been really strong this year, and some people think it might be a bubble.
Yeah, that's a question that always comes up when the market seems to be doing its own thing, kind of disconnected from the real economy. Powell's answer was pretty much what you'd expect. They're keeping an eye on things, but they're not trying to, control the stock market. Their main focus is still, their core mission, inflation and employment.
So, no need to panic just yet. But what about another market that has some people freaking out? Bitcoin. One reporter actually asked Powell if he thought it would be a good idea for the U.S. government to, build up a reserve of Bitcoin.
Well, that's interesting. What did he say?
He basically said, thanks, but no thanks. He pointed out that there are rules about what assets the Fed can hold, and Bitcoin isn't one of them. He didn't seem too keen on changing those rules either.
So the Fed's not jumping on the crypto train anytime soon.
Doesn't sound like it.
Right.
Makes sense, though, right? Given that they're all about stability and crypto is, well, anything but stable.
Yeah.
Okay, last question for you. What do you think was the most important thing to come out of Powell's press conference? What should our listeners be thinking about as we head into the new year?
That's a good question. I think if I had to boil it all down to one key takeaway, it's that the Fed is in a really tricky spot. They're trying to do a lot of things at once: support economic growth, keep the labor market strong, and get inflation back down to that 2% target. They're making some progress, but it's slow going, and there are definitely going to be some bumps along the way.
Sounds like we're in for a bumpy ride then.
Yeah.
Any parting words of wisdom for our listeners as they try to figure out this whole economic situation?
Yeah, stay informed, stay engaged, and don't be afraid to ask questions. The economy affects us all, so it's important to understand what's going on.
Well said. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.